Hello and welcome to BloombergQuint. We are in conversation with Dr. Krishnamurthy Subramanian, Chief Economic Advisor to the Government of India, having the opportunity to speak to him after budget so we can cover both the budget and the economic survey and highlights there. So thank you so much for taking the time to speak to us. Appreciate it.
Very nice seeing you.
I am going to actually start, Dr. Subramanian, with the financial sector before I go into the macros behind the budget. Only because I know that you have deep experience there. I love talking financial sector. I think a big change came through in the budget this time with the intent to privatize two public sector banks. The reason I bring that up is because I know that IDBI had been privatized or looked at earlier. But with this intention, we are actually going in the direction of changing the Bank Nationalization Act, which signals an intent towards a more privatized banking sector. Are we reading that right, sir?
Firstly, I would say that, and you may recall, last year we had written a chapter on the golden jubilee of bank nationalization. Net, my view as an independent researcher in this area is that while there have been, wins that have been generated through bank nationalization, I think, we could have certainly done much, much better. And in that sense, I think this proposed privatization of two of the public sector banks is a really welcome move, for me, number one. Now, the reason I actually talk about this is because, even before COVID, for almost a decade, we've actually been living through a financial sector, banking sector especially, that has severely underperformed. And this is not the only episode. Even in 1998 or 97, 98, around that time when the economy, was impacted because of the Asian financial crisis, at that time also the banking sector was affected. So I think, the banking sector is something that has had me worried about in terms of the need for reform, actually significantly. This sector has not done very well either in terms of the quantity of credit, the credit penetration, and we showed that in the economic survey last year. If you recall, on any metric in terms of the penetration, controlling for GDP per capita, population, you name any metric, we actually are just so far behind. We don't, the largest bank that we have is 55th ranked in the world, when other countries like, those that are as big in size actually have, 2, 3, 4, and maybe sometimes 17, 18 banks. So that's in terms of the size, and the quality also continues to be a big problem, especially in the large corporate lending. That is something. So I think this is a sector that has been crying for reform, and this budget has really provided that impetus to reform. And I'll lay out some specific things. First is, of course, the bad bank. I think that's a very good move, and having the bad bank in the private sector is something that is important because I was not quite sure that a bad bank in the public sector would do much good, because they may be basically just replication of the same problems that public sector banks themselves face. So that's number one. And we can talk about it if you have further questions. Second is the privatization of the two public sector banks, which will require the change in regulation, because do remember that the Bank Nationalization Act, which is what provides the validity to banks, is based, that comes from the Bank Nationalization Act. Now, the Bank Nationalization Act actually does not treat these banks as corporations. They're not corporations under the new Companies Act of 2013. Boards are hard-coded. There's actually things like the directors, CA director, workman director, all these kinds of oddities that actually were created in 1969. Become actually completely anachronistic in the current environment. All that needs to be unwound in this context. The third is the DFI, and not only will this legislation bring in public sector DFI, something that was tried earlier with IDBI, ICICI, but they ended up becoming just entities for giving corporate loans, not really for infrastructure. and there were lessons that has to be learned. But more importantly, this legislation will also enable private sector DFIs to come in, and that is something which is very important from the infrastructure financing. So that's the third thing. The insurance sector increasing the FDI from 49% to 74% with necessary safeguards, I think is also important, because insurance is another sector where we are severely underpenetrated. So when you put all these together with in the last budget, some of the important changes in terms of the netting bills, actually CDS, credit default swaps, and the factoring legislation that was also brought in during the COVID, and so when you put all this together also the GFSC that is being the IFSC which is happening, I think in the next decade we will be seeing significant changes in the financial sector. So collectively they all add up to actually more than the sum of their parts.
Understood. May I just ask a couple of specific questions, and I'm not going to go into the micro detail because I know that that's that would be a waste of your time. But I do on privatization want to understand, because that to me is a big step and a change in direction. Now, every time we have spoken to veterans like, Dr. Vavi Reddy, etc., they've said that you have to essentially take a decision on what is the share of banking that you want under the public sector in the current economic milieu. I'm wondering if that's sort of the exercise that has happened at the back end in the government. How do we think about it? Because you've said 2 banks, right? We don't know which banks. We don't know how large the banks is. So the right way to think about it is to understand what is the share of the banking sector that the government thinks can be now privatized.
With all due respects to very, very experienced hands and capable hands like Dr. Vavi Reddy, I tend to think about this in a different manner. I think fixing the private sector share is not really the objective. The objective is to enable the banking sector in terms of both the quantity and the quality. In terms of credit penetration, for instance, if you take the private credit to GDP ratio, we are at about 50-odd%, and the average for OECD economies is close to 200%. And there are areas like the Northeast where the private credit to GDP ratio is less than 10%. So really, really lots of scope for improvement. Similarly, the quality, and especially every time we have a banking sector problem, it comes from the large loans. Our banks have just not, including the private sector banks, have not found a way to be able to make the large corporate loans without actually suffering the NPA. So, in other words, the objective that I want to lay out for the banking sector is that both the quantity and the quality of lending needs to be enhanced significantly. In that context,
to privatization necessarily, right? I mean, the private sector banks are the first to pull back on lending at the Swiss school.
No,
I'm not sure the quantity aspect gets resolved. In quality, we've seen private banks run into trouble too.
No, I was going to come to that, right? So in that context, on average, the performance of the private sector banks has been better on average. There are certainly exceptions, and this is something that we showed very clearly last year's chapter on the golden jubilee of bank nationalization, where we had these box plots where we actually showed the minimum, maximum in terms of ROA, ROE, etc. And there we saw that yes, and I think the word yes has a pun in it as well. That certainly there is actually the odd case of the private sector bank that has not done very well, but on average, private sector banks have done better. Yes, there are some banks that have chosen to not get into large corporate lending at all, but those that have gone in have burnt a little bit maybe their nails, but not the entire finger, if you will. So, and that is because on average governance, in the private sector banks actually has been better. Though I think there's a lot to be desired in the kind of happenings that happened in some of the banks without naming them. Therefore, I think, the government also agrees that there is a need to actually move, away from the current situation, where So banking will be a strategic sector where there will be four, or less. I think four public sector banks definitely. But the rest need to actually be slowly be sort of unwound and put into the private sector. So this is, in my opinion, actually the the start of that process.
Okay. On the bad bank, sorry. Now, this is a private sector entity where the banks will put in capital. Why is it any different from an RSIL or any other private ARC which has not met the objective, Dr. Subramanian? I think the point of having a government-owned entity was that PSU banks would be more comfortable selling their assets at a deeper discount because the CVC, problem will not come in. If you're expecting the banks to set up another entity, why would that be any more effective than the 15 ARCs we have?
No, I think that's a fair question, Ira. But what we have brought on this in the budget, actually, even though it was sort of one sentence in the budget speech, there's been a lot of thought that has gone behind this, and working across actually agencies that has also happened, including the public sector banks. Deliberations have happened. So what you see is actually just one line, but there's a lot of homework behind it, and I'll explain why. Firstly, if you leave out, maybe a couple of these ARCs, the rest of them are not adequately capitalized, because what we are talking about here is, non-performing assets of the tune of 2 lakh crores at least, maybe more than that. And many of these ARCs, really do not have or have not done as well on assets that are more than 500 crores for this. The large assets, which require very different, skills in terms of the way, the way they are managed. Because do remember, not only in India, but all over the world, when you talk about bad assets, restructuring them, that involves both operational and financial restructuring. And that requires significant expertise. And, especially the larger assets require far more of that. So that's and the current setup has not been able to provide that, save maybe a couple of them. A problem with creating it in the public sector would have been that the scourge of the 3 C's in terms of the decision making, it would have been really big. Because, for instance, I'll give you an example. Let's say you have a bad loan that actually where you gave $100. Today the value of that is only, let's say, $80. Okay. And remember, this is all subjective. You may think it's 70. I may think it's 80. And that's why it involves a lot of judgment. Now, in the private sector, actually, this judgment can be made far better. For instance, in terms of financial restructuring, that this bad bank can say, okay, why I will take, let's say, let's write down the value of the asset to 82, so that we actually have, by writing it down, there is actually enough for both you and me. But in the public sector, that will raise all kinds of questions. They basically, why 82? Why not 95? $18. Maybe there was something that was changed hands between private individuals. All these kinds of questions. The same problem that hobble the current public sector banks would come to actually to afflict this bad bank as well, which we did not want. We were very clear about that. At the same time, there is also the problem of moral hazard that comes in when you actually have the taxpayers' money put into the in this, especially given the asymmetric information problem that is always there in any bad loan, much higher than in a typical loan itself, is not doing very well. So the moral hazard can become significantly large, which is why this has been done in the private sector. But there is also, and the details when they come out, you will actually see them, that the reluctance of the public sector banks to sell them, at these discounted values has also been thought through. There's a fix for that as well, in the way in which the government will actually be involved, possibly in giving a guarantee, so that the receipts that are given, will actually also ensure that there is a stake for the public sector bank in it. And so these all aspects have been thought through and have been deliberated upon among all the stakeholders. So when the details come out, you will see that this is actually, in my opinion, brings in the good of the private sector with the, with some of the necessary backing of the public sector.
So there would be some government involvement. I mean, I don't know.
Yes.
Guarantee part.
That is also important for the central bank to also have the necessary comfort. So, of course, if there wasn't, it wouldn't have been announced in the budget, right?
Exactly my point. But then the government officials came out and said that this will be all, it'll be budget neutral for the government.
Yeah.
And it will be the banks putting in the money. So wondering where the government's involvement is. So
the government's involvement will be in actually facilitating this, and if necessary, providing some guarantees. Being sort of the, let's say, maybe taking a first loss, for instance, that's something which these modalities will have to actually be worked out, the specifics. But government is actually, you can say government is sponsoring this effectively and is there to actually facilitate and, iron out whatever, problems are there. But I will say that there's a lot of thought that has already gone into this. We've been working on this for a few months.
So guarantee on what? Recoveries from the assets sold, and they're sponsoring then without putting money in. How do you call it?
No. So see, the capital will come from the banks, basically the bank. So it will be set up as an AIF, and a management company structure. That's how it's going to be set up. But so that there is a comfort for the public sector banks to be able to sell it without having to actually take too much, of a hit, and the uncertainty about how much value gets created actually is also taken care of. The structure will be created in such a way. Some of these details will actually, emerge as. So there have been, of course, deliberations between the ministries, which is your DFS and the banks, and I also reckon that the central bank has also been involved in this on some of the details. But all I would say is that this is not something which has been brought without adequate thinking. There's been a lot of thinking on this. So I think the major problems, which is moral hazard, and the problem of decision making on the public sector, has been avoided. At the same time, the major problem on the private solution side, which is the reluctance of the public sector banks to sell at discounts, also has been thought through. So these are sort of the main problems which are thought through. So I think the structure should work, in my opinion.
Okay. Sir, one more question on financial sector, and I don't want to end up with not having enough time on the macro side, but very briefly, the ECO survey had talked about a new AQR. That came as a surprise to everybody. Can you tell me what's in, what drove that suggestion? Do you believe that even after the first AQR, the level of stressed assets in the banking sector reflected on book is not truly representative of the stress sort of behind those numbers?
So, that chapter on regulatory forbearance, was written with the primary objective of highlighting that forbearance needs to end as soon as recovery, happens. So the main message of that chapter is basically that, and as I've made it very clear, the effort is to try and give direction for what we should avoid in the current round of forbearance. And that's why, if you look at, I have given this example in my presentation as well. If you're sick, you go to a doctor, the doctor actually asks you to take some emergency medicine for 3 days, but you're scared that the disease will actually persist. So you take the medicine for 3 months. Obviously, your health will get spoiled. You won't get better, which is exactly what happened with the forbearance the last time. 7 years, the forbearance was continued, and 2000, even after, and we've shown through several charts, one after the other, GDP growth, exports, IIP, your credit growth, and showing the restructured assets. Everywhere we show 2011 is when things were looking good. It should have been discontinued. So that is the main point. Actually, I think the AQR part is the second and the minor half, but the bigger lesson is to basically keep in mind that forbearance is emergency medicine, not staple diet. And I think that is something which is now why is it that, the last time the AQR was done, and it was the right move to do the AQR, because, whenever forbearance is given, that does lead to asymmetric information between the regulator and the banks. Those assets that are being forbeared, are they indeed, once the forbearance is lifted, are those actually in good quality, or are they not in good quality, is something that has to be, of course, first thing ascertained by the auditors, and they are not without blame, by the way, auditors, because they're the first line of defense. Second, the boards of the banks, that's the second line of defense, and the regulator is the third line of defense. And each one of them is culpable in different measures if basically these bad assets are not brought out properly. But in the Indian context, keeping some of the realities of the auditors and not very beautiful realities, and the boards, it is important. There will be asymmetric information that will persist between banks and the regulator, and that is why the AQR is important to implement. We do not want a recurrence of what we've actually had. As George Santayana said, the Spanish philosopher, if you do not learn from history, you're condemned to repeat it. So that is the main intent. The asymmetric information between the banks and the regulator cannot be allowed to persist.
Dr. Subramanian, on to the macros then. So I think yesterday, both the fiscal deficit numbers sort of surprised to the upside. It now seems clear that some of it is a cleanup of, the balance sheet and bringing budget stuff, a significant part. So can you actually, either through numbers or just qualitatively explain to us what part of this is off budget coming on budget, which is not a sort of new spend, and what part of it is actual spend, fiscal multiplier, as they call it in, fiscal impulses, they call it in your economic language?
Firstly, let me give you the, sort of the rationale. And chapter 2 of the economic survey had actually made the case that, for counter-cyclical fiscal policy. If you look at the very first, set of charts in that chapter, where we actually show the private sector balance and the public sector balance, for India, US, and UK. And, the private sector balance and public sector balance are just sort of jargon for how the private sector is doing versus, and how much is the government basically coming in intensively, sort of supporting through its fiscal policy. If you look at the US and UK, that correlation over 1986 to 2019 is minus 0.9. In other words, when the economy is doing very well, the government, basically the fisc, steps back, consolidates its fisc. But when the economy is not doing very well, the private sector is not in good shape, that's when the government steps in and actually really, increases its spending. That's counter-cyclical fiscal policy, and it's followed in a religious manner in the advanced economies. But if you look at India over the same period, the correlation is minus 0.29. And, one of the key things, economists talk about is R squared is the square of the correlation. So the R squared in the advanced economies is about 80%. In India, it is actually less than 9%. And that is the essence. So we've not followed counter-cyclical fiscal policy generally, but that is extremely important, because what counter-cyclical fiscal policy does is, intrinsically in any economy, you have actually ups and downs in the business cycle. Now, when fiscal policy is counter-cyclical, as I already explained, these peaks are reduced. Compared to the intrinsic peak, your macroeconomy will actually have much smaller magnitudes of oscillations, because the government is spending and doing exactly opposite of, and that is really important from macroeconomic uncertainty to go down, investment to increase, etc. The second point is that fiscal multipliers are much higher in a crisis like now, and that's why government needs to step into. So that's the rationale for the increase in the fiscal spending. Now, where is this money best spent? It is on infrastructure. And that is why if you see a 32% increase in the budgeted amount for capital expenditures, so, aggregating to 2.5% of GDP, an NIPFP study shows that infrastructure, the multipliers are 2.5 in the year when it's spent, and overall 4.5. So about 6% of GDP can come just from the infrastructure, this year, 2.5 times 2.5, basically. That's one key, aspect. At the same time, healthcare also, which is also soft infrastructure, and which really helps because it enables labor productivity, etc. Now to come to your, on the part of the, so I partly answered your question that there is a lot of spending, clearly fiscal spending that is being done, but some part of the, of the increase in the fiscal deficit, especially for the coming year, is because of the off-balance sheet items being brought in, within the, the balance sheet. I think from a transparency perspective, from the credibility of the budget arithmetic, I think it's something which is, very, very good. And I, as an economist, just love that part, in terms of, last year this was started, and it's been completed now. The extent is about, my estimation is, somewhere around, I think 2.7 lakh crores or so might be the, but I'm just giving you some flash estimate, quick estimate. We have to check. It basically includes the FCI, the borrowing done by FCI, etc., which has been brought in. So that's sort of the overall. But to your original question about the actual fiscal spend, that is actually significant, despite the cleanup. Even if you take, so that 2.89 would be around 1.1% or so. Even if you take that into account, still there is 5.4% which is just direct spending. And on good spending, the quality of spending is also important. That contrast with the what we did after the 2008 financial crisis. Fiscal spending was increased, but it was all revenue expenditure. There was very little capital expenditure, and there were no reforms on the supply side. And that is something which you notice this side. We've recognized that the crisis affects both demand and supply. And because there were no reforms on the supply side, what you had was inflation, runaway inflation in double digits, which inevitably will happen because you're putting money in the hands. Demand will go up. Supply obviously has not responded. Econ 101, which was not done then, and therefore there was runaway inflation.
Okay. Sir, one last question, just because I'm running out of time. So I understand, the reason for the higher fiscal deficit, both in FY21 and in FY22, and I also understand the reason for moving more slowly to 4.5% by FY26. I'm going by the, FM's budget speech numbers, not the Commission's numbers. But a consequence of that is going to be that we will have a period of high borrowings persisting for some time. That's going to be a tough managing act, for the central bank, right? I mean, because you will see those resources.
No, I don't think so. I don't think so. I'll tell you why. Because firstly, the historically high borrowing that was done this year, actually happened with yields coming down, number one.
For one specific reason, that suddenly you had a boost in household financial savings, which, you can't imagine will last.
Absolutely. And I'm coming to that, which actually expanded the supply of savings. And which is the second argument I'm giving you. If you look at the last budget, the special category bonds that were created, those will actually enable India's inclusion into the bond index, and the bond index actually will bring in significant amount of supply. Because
not yet, they haven't signaled that yet, Dr. Subramanian, and I'm saying that because we've been hearing this for at least 5 years now.
No, but you may have been hearing it, but the last year's budget speech had a specific, provision for this, right? So, hearing is one thing and actually for it to be announced. And yesterday, you would recall in the, the press conference as well, Secretary of Economic Affairs mentioned this specifically as well. And so that is something which is being done. So the overall, the supply that will increase as a result of that will definitely help. Also, see, the investors look at the credibility of the budget arithmetic. That's in fact, I've always felt that when, budgets try to sort of come up with some number and do some, jugglery, that in my opinion is always a lose-lose, because investors can see through it and it never, helps. But in this case, therefore, the reverse is also putting it everything above board is win-win. And, especially fixed income investors look at some of these, these aspects very well, and having worked in fixed income markets myself for some time, actually, I can tell you that this is indeed true. And when they look at the growth that had the credible, policies that have been taken to for growth, I think it will, there shouldn't be a concern. Last point, which I will say also, I think the way in which India has basically responded during the COVID pandemic on its policy, And we showed this very clearly in the first chapter of the economic survey. We were willing to take short-term pain for long-term gain. We made that very clearly that it is the initial lockdown, which was driven by research, both epidemiological and economic research. That is what led to the saving of more than 1 lakh lives and the V-shaped economic recovery. The investors take note of such things as well, such maturity in policy making. So I think all these, when you put it together, I don't anticipate any difficulty.
All right, I'll leave it at that. So thank you so much for taking the time to speak to us here on BloombergQuint. Really appreciate your responses.
Thank you.
Thanks for watching Bloomberg.